Hello and welcome. I'm Jonathan Beale and this is the ASB Investment Podcast, a show that keeps you up to date on the market and helps you make smart choices with your investments. These are entirely our own views. It's not investment advice, but we know plenty of experts at ASB that'll be happy to chat if you need. As New Zealand enters its second week at Alert Level 4, Chris Tennent-Brown is back to talk about what the lockdown means for the economy and companies we invest in, as well as ASB's investment team. Good afternoon, Christopher. I think you're sitting at home in Onehunga, aren't you?
That's right. This is nowhere near as cool as sitting in a studio. I'm in my living room. And so we might hear a few different sounds, like some cars driving by, maybe one of my cats coming in. I'm not sure.
Exactly, and I'm sitting at home in Stanley Point downstairs, and I'm wearing my son's Xbox earphones and microphones, so I feel a bit like a gamer. But these are the things you have to do when you're in lockdown, and I suppose we're all learning to live in this very strange situation, and so we're trying to do this podcast remotely. So I'm at home, you're at home, and then the guy in the studio is at home trying to record it. So it may not have the awesome quality we have previously, but we'll give it a go and see how we go. But we thought it was just important, I suppose, Chris, wasn't it, so that we sort of update customers on what's going on. It's quite a fluid environment we're living in at the moment, but we thought we might tackle some of the big issues. And but firstly, May, how are you finding working from home?
It's really interesting. We still have regular team meetings. We get together and talk about what's going on in the economy. We're still doing our economic forecasts, and so that stuff's the same. It's just that we're using all different sorts of technology to do it. I could do with having a teenager to come and explain how some of these systems work from time to time. I'm hopeless with technology, but I've got an iPad, my iPhone, my work laptop, all going so that I can talk and communicate with people on a variety of different channels and do the usual spreadsheeting that economists do to keep our forecast rolling. So it's an amazing thing to be doing the same job from a completely different setting.
Yes, and it's good to hear that the spreadsheets are still working. But I'm the same. I'm probably on the phone more than I ever have been in my career. I seem to be on the phone all day, and we're working with things like Microsoft Teams and Zoom, and the thing that's been really impressive is that the bank has moved like the majority of staff working from home. The investment teams that work in the bank are all working from home, and actually are probably speaking more in this environment than they have done previously. And people like our advisors, so First Sential, who do the asset allocation in Singapore, they're working from home, and all our underlying fund managers have put in place their BCP, their business continuity plans, and are working either remotely or in teams of A and B. And actually, we've seen no reduction in service levels at all. Our unit pricing is being done on time. Liquidity, which is always a concern maybe at these times, is still good. And I suppose it's one of the advantages of the way ASB invests money in good quality companies that are on markets that trade. So that makes it really helpful for customers to know that their money's safe. But what I'd maybe to bring you in, Chris, maybe we wanted to talk a little bit about this level 4. So we now understand level 1, 2, 3, and 4. We moved from 2 to 4 pretty quickly. But what does level 4 in your eyes mean for the economy here in New Zealand?
It's at a really basic level. It means a major shock to the economy. When we first started recutting our forecasts, essentially what we're doing is trying to work out what's it going to mean if we take international tourists out of the equation and start restricting some of the activities that are taking place, and that led us to having a short contraction in the second quarter and some weakness in the first quarter of this year. Now, when we're talking about the whole economy in shutdown, essentially nothing happening in terms of normal retail sales and services apart from supermarkets. We're talking about the economy contracting well over 10% in the second quarter of this year that we're into now, and so it's just a much bigger contraction, a much bigger hit to larger parts of the economy. Things like the unemployment rate now we've got going higher than what we did when we were cutting our earlier forecasts. So it's a big shock to the economy, and at the same time, the government's doing a big job of filling in the pothole, if you like, of income that takes the hit. With these massive expenditure plans that they're unrolling at the moment.
And that will come on to the sort of government support, which has been quite impressive, not just here but around the world. But are there particular industries within the economy that are being hit harder than others in your eyes?
Well, first up's the tourist sector. That's just non-existent now, right? With international tourists going, and then us all stuck inside. We can't even have domestic tourism as a fill-in, like we were thinking in our earlier forecasts. But now with the shutdown, it spreads to the services parts of the economy, restaurants, cafes, bars, everything that we normally do to spend money is closed. So we're seeing that now when we look at things like electronic spending data for last week, we can just see that spending's been completely disappeared from a number of areas now, and that leads to this big drop in economic activity that we're talking about. So if I think of purely economic activity, on the one hand, we were just talking before, our jobs carry on as normal and we're just doing them from home. But in terms of our output, it's hopefully the same. We're just doing it a different way. On the other hand, a cafe or a restaurant now can't do anything at all. So hence we get overall this big hit to economic activity and the economy contracting. We think at the moment by about 15%.
Okay. And then does the length of the lockdown obviously has impacts on how the economy is going to get sort of worse, and also how quickly it will come out of recovery? Are we hoping that the lockdown doesn't get extended, or does it not make too much of an impact?
Yeah, absolutely. The length of the lockdown has a big impact, and I think what everyone's hoping is that the short, sharp shock of shutting down, containing the virus, taking the pressure off the healthcare system, ultimately means that we can get back into it in a few months. If that's not the case, then it takes longer. The economic hit gets bigger. The government needs to do more work to support people. And really, in that vein, we're looking so hard at the economies that are now coming out the other, or look like they're coming out the other side of it. So how China is going as they come out of lockdown, how South Korea is going. Those are really important guides for us to see what happens next, and whether these really tough measures contain the spread of the virus, and then people can get slowly back on with their lives and with their work. That'll be a story we hope for sort of June, July onwards, and start to see a bounce back in activity in the third quarter of the year. But it's going to take us a few years to get back to where we would be if it wasn't for this lockdown one way or another.
And then sort of thinking a little bit more granular, so you've talked about the economy. If we sort of move down to sort of companies, and there'll be a lot of companies, particularly in New Zealand, who pay, say, dividends, and we've seen obviously share markets fall back, and we've seen a bit of a recovery. But for people who've got invested in shares who have the companies paying dividends, are we going to see those be affected because of COVID-19?
Yeah, there's a lot. Well, a lot of companies are obviously going to take an earnings hit over the current quarter, and that'll impact their ability to pay a dividend. A company like Air New Zealand's probably the best example, where they are just having to make massive changes, and they won't return to any sort of profitability until we come out the other side of this this shutdown. So that has an impact. And there's other companies in between, like the utility companies, power generators, etc., where they'll be seeing less power usage from companies while they're shut down, more power use from people at home. But as we get back to business over the next quarter or so, they'll continue on their ways of being reasonable, profitable businesses and decent dividend payers. So it will be mixed, and it will be influenced by how long we carry on. But that dividend yield is an important part of the investment story for the New Zealand share market, and we'll be keeping a close eye on that. And I'm sure a number of companies will want to get back to paying dividends as quickly as they can.
And a lot of people would have invested in the New Zealand share market because of the dividends, because interest rates were so low, and then the government responded at the beginning of COVID-19 with quite a bold cut of the official cash rate, which will obviously mean interest rates are going to be, to coin our phrase, lower for longer, or much lower for longer now. But sort of bonds and fixed interest seems to get sort of not really talked about, and so the government have reduced the official cash rate. But are they doing anything else around sort of fixed interest and bonds to help those types of markets?
Yeah, that's a really good question, and I really feel for savers in this sort of environment, particularly conservative savers, some of our elder savers, because these low interest rates are just so tough on them. So you're right. Firstly, the Reserve Bank cut the official cash rate down to 0.25%. We haven't seen big drops down in term deposits off the back of that. They're already low, and they haven't got much lower since then. But we have seen some really big movements in bond markets. Some of this was more to do with just the outright volatility we saw in March and all markets. But the Reserve Bank is now in the bond market buying government bonds each week to try and keep those government bond yields low. The government itself is really stepping up issuance into the bond market because now they're running these big deficits to try and keep the economy going. And the Reserve Bank will be buying a lot of those bonds through their operations. The end result is yields were volatile for a few weeks there. They were bouncing up and down a lot. Now they're back down to being incredibly low. So something like a government bond, a 10-year government bond yields back down close to 1% at the moment. So we're seeing incredibly low yields in the fixed interest markets. We're seeing the government intervening. One area where we're not seeing such low yields is the corporate bond market. Corporate bonds the yields have actually increased. And again, that's a little bit of a sign of investor caution, some worry about the outlook for companies. And they're still very low on a historic basis, but we have seen a lift in corporate bond yields over the last couple of weeks as investors reassess the outlook for some of those corporates.
And a lot of investors will have a proportion of their investments in government stock, or government bonds, and corporate bonds. And I suppose the government, is trying to bring some stability to that part of people's portfolio. Is that the idea where they're buying bonds?
Well, ultimately, what the Reserve Bank wants is interest rates to stay low in the economy, and the system to function well, so businesses can borrow and the government can borrow at low rates and stimulate activity through investments. So that's good news for those companies, and good news for people with mortgages. It's a bit mixed. It depends where you're coming into it from an investor perspective. But you're right, that message we've had of lower for longer in the fixed interest space and the term deposit space. Well, I don't know how many times we can tack a new word on the front, even lower for even longer. Or some people are starting to say lower forever. I don't think it'll be lower forever, but it's certainly interest rates I think are going to be low for several years ahead of us.
Maybe moving on a little bit, one of the things I'm hearing a lot is, this is just like the GFC, the global financial crisis. One of the things I've noticed is the response from governments has been just incredible. Like the figures that people are quoting, like $1 trillion and hundreds of billions of dollars. It seems to be a very different response to COVID-19 than to sort of the GFC, and maybe sort of to help people who are listening. So what are sort of governments trying to do by these huge stimulus packages? What are they actually trying to achieve by doing that?
Yeah, it's right. People are comparing this to the global financial crisis, but in the name, there's the answer. It was a financial crisis that sent shockwaves through the economy. Now we've got a crisis in the economy it's a health crisis that's causing shockwaves to the economy and in turn impacting the financial sector. So it's a bit different from the global financial crisis in that sense. But a lot of the answers to how to get through it are the same as the global financial crisis. Central banks need to get interest rates low, and they need to make sure that there's plenty of liquidity in the financial system. This means when people want to raise money, or people want to get money out of stocks, or people want to put money into or out of the banking system, that's able to happen as it usually does. So the Reserve Bank's done that work with their efforts so far by cutting the official cash rate, by entering into the government bond market. So the difference between now and the global financial crisis is this has happened so swiftly. From the government's perspective, the government has got a bigger job to do in this situation than the Reserve Bank does, because we're seeing incomes getting hit because of the shutdown, and this is where the government's coming in and replacing that income. So supporting people that have lost their wages, supporting businesses to make sure that they can get loans, and other measures like the rent freeze to just try and create some stability for tenants, etc. So there's all sorts of policies that the government's coming up with, and we haven't seen the last of them yet. They'll keep on tuning those policies. But just like the Reserve Bank, what's impressive now and different from the global financial crisis is this is all happening right at the start. And so that's just an amazing response. And it gives me confidence in our forecast that we should see a good recovery coming out the other side of this once the medical situation allows.
Yeah. But are we potentially, people have been asking me this, are we sort of kicking the can down the road for a few? Are we setting ourselves up for some challenging years ahead by just borrowing all this money?
Oh, there's no doubt that this has a cost on future generations. There's a good analogy that it's a little bit like an oven. You can't just let the oven go completely cold and then expect it to be back working quickly. You want to keep it warm. That's what you're trying to do at times like this, but there's a cost for that. All the money that the government's putting in the economy has to be borrowed, and that will mean that the government carries more debt over future years than would have otherwise been the case. And it's our governments, both the current one and earlier governments going back about 20 years, have worked really hard to get debt down to an incredibly low level, about 20% of GDP. That's low on a global standard, it's low by New Zealand standard, but it's going to get back up. We think it could get back up to 50% of GDP. So future generations will have to pay for that. There is a cost. The good thing is at the moment that interest rate cost on that debt is so low, about 1%. In the global financial crisis, governments were paying a lot more for their borrowings than they are today, that's for sure. But there's no doubt there's a cost of these policies, but it's the right thing to do.
Yeah. And so when, Chris, when you're sitting at home in your luxurious Onehunga villa, what are sort of things are you watching at the moment to sort of keep abreast of? Because I know it's moving very quickly, but what are some of the maybe 2 or 3 things that you're watching on a daily basis to see to inform what's going on?
Well, I think the first thing is that traditional economic forecasts go a little bit out the window at the moment because the situation changes so much. So I've been looking at real high frequency data like credit card spending just to confirm how people are behaving. And we're seeing things which are understandable, a massive step up in the amount of expenditure at supermarkets over recent weeks, and virtually no expenditure now in bars and restaurants. And I'd expect none at all going forward from most bars and restaurants. as they're almost all closed. But that's really, really important now to see where the pressure on businesses is going to be coming through. And it'll be really important once we slowly start to open up to see how people spend going forward. The other thing that I think is really important to keep an eye on for us as forecasters, but also for people in general, is just how these measures are working. No one expects this lockdown to have an immediate effect of stopping people from getting sick. It's a case of containing the contagion and trying to spread the load over for the medical profession. And seeing how that works is really important, both here and abroad. So I've been really encouraged by some of the international statistics, really disappointed until recently with the American response to the situation. And here I'll be really looking hard over the next 10 days or so to see what happens with the daily reporting cases of new cases of COVID-19 now that we've really stepped up the testing measures. In other words, I'm just looking for signs that this is working. And then once it does look like it's working, signs of how people spend once we come out the other side so we can work out how quickly the economy can bounce back.
And one thing I'm following quite closely, obviously, the share markets, but I suppose it's those in the last few days or last 5 days have just been quite incredible, really. We had this sort of blind panic and huge downward pressure on share markets around the world, but then it's just sort of, I don't know if it's the bottom, but it just seems to have sort of, we've had some quite big increases, and the last few days has been pretty much sort of calm, I think would maybe be the word to use. That's quite an interesting sort of recovery or view that markets just seem to have just sort of settled a little bit. Do you see that continuing, or is that just sort of what happens and we're expecting some more volatility as we go through the lockdown?
Yeah, that's a really interesting question, and there's a few bits to the answer on that front. The first one is around 23, 24, 25 March, we saw a tremendous volatility in markets. There was just a lot of people wanting to get money out. At that time, we saw share markets really weak, really volatile. These were those days of the big movements close to 10%, and a lot of demand for US dollars around the world. That's the main reserve currency. The majority of transactions take place using US dollars as one part of the currency pair. So that was when we saw big movements in bond markets, big movement in share markets, big movements in currency markets. That was the time when central banks also really started stepping into markets to try and create some calm, make sure there's plenty of liquidity. And that's worked so far. So we've seen those policies work. Bond markets have calmed down, currency markets have calmed down. Share markets have taken a lot of encouragement from that, but also from these spending plans from government really starting to kick into place. You know, the US politicians finally got their $2.2 trillion rescue package or rescue bill sorted out and into law. Markets were encouraged by that. Here we're starting to see the data showing that the money from the government's spending plans is in people's bank accounts. So these policies are in play now, and that's been encouraging for share markets too. I don't think it's all over. There'll be more bad news to come. Markets don't like uncertainty, so we're probably going to see some more down days. But there's been a lot of measures put in place so we don't see that really high level of stress like we were seeing in late March. Hopefully. The other thing that the last week is a reminder of, and this is just like the global financial crisis, is markets will start responding positively, not because all the clouds clear and flags are waved saying it's all over, but just when there's some real pivotal moments. And these big spending packages from governments around the world were pivotal moments. The other pivotal moments that I think we'll see over the coming month is just where those cases go. And this is that bit I was talking about before, where we're really looking for signs that these shutdown measures that are hurting the economy so much at the moment are actually working for solving the problem. I think when we start to see a slowdown in the number of new cases coming through in the States, that'll be really encouraging. On the same note, we'll be nervously watching to see how economies like China, for example, press through once they get back to work. So there's plenty more things to watch that markets will respond to over the coming weeks and months. That's for sure.
That's for sure. And then finally, I suppose we've talked about this before, and you're always really hot on it about sort of dealing in the facts rather than sort of some of this fake news and speculation and stuff. There are a couple of places where you would recommend people go to get information about what's going on generally? Any sort of websites or publications that you look at that would be helpful?
Yeah, I think there definitely are. I mean, I look each day at the international websites that are showing the number of new cases. So the World Health Organization website is one for that. There's a John Hopkins Medical website that has the global cases of COVID-19. Those are the source of truth as far as I'm concerned. And likewise, the COVID-19 government website is my source of truth, and the live broadcasts. What I'd put to add to the mix on that is I look at those all the time because I'm trying to provide really up-to-date forecasts to help our clients with their decisions. But it's really important not to go too nuts on it too. There's a lot of repeated information. You can tend to go round and round and round on issues, but those are good sources of truth where things are at. And I quite like the Minister of Finance and the Prime Minister's comments that they are our source of truth on this. So hence why I look to their releases for information on what's happening in the economy.
Yeah, I'm the same. I also, I think I listen to the 1 o'clock sort of news bulletin just to sort of see what's happening. Also, if you're sort of ASB customers as well, the ASB website actually is a really good place to go to get information about COVID-19, what's going on. Simple things about what branches are open, but also how the bank can help as well. So I think that's a good source of truth as well, and lots of information in these crazy times. But hey, Chris, I might bring it to an end there. It's been, I think it's like the last week. It's been a bit surreal doing it via my headset, and I can't see you, and I haven't got a glass of red wine in my hand. But just again, thanks for all your comments and the clear way of explaining things. I really appreciate it, and I'll let you get back to your day job sitting in Owenhunga.
Yeah, that's excellent. Thanks, Jonathan. And yeah, I just reinforce that message that the ASB website's a really good place to go for people looking for updates and information on what we're thinking about, all sorts of issues, the economy, what it means for mortgages and all of those sorts of things, because it is an unusual time where we're all working in different places, but it's great to be able to talk to you.
Exactly. All right, keep safe, and keep safe to everyone who's listening, and speak to you again soon.
Okay, bye-bye.
Cheers. Thanks for joining us today on the ASB Investment Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on future shows, please fire your suggestions through to podcasts@asb.co.nz.